In the world of finance and commerce, understanding the tools and instruments used for payment and credit is essential. These tools not only facilitate smooth transactions, but also ensure that businesses can operate efficiently and securely. One such crucial instrument, widely used in both domestic and international trade, is the bill of exchange. This financial document has been a cornerstone in trade for centuries, providing a reliable method for settling debts and payments. Having a clear understanding of bills of exchange is vital for businesses, accounting professionals, and anyone involved in financial transactions. It helps in managing cash flow, ensuring timely payments, and maintaining good business relationships. This guide aims to provide a comprehensive yet straightforward explanation of bills of exchange, their significance, and their application in today's business environment. We will break down complex concepts into easy-to-understand segments. Bills of exchange offer a secure and legally recognized method for settling transactions, providing a written, legally binding promise of payment. This ensures that both parties in a transaction have a clear understanding of the payment terms. They play a crucial role in facilitating smooth trade operations by providing a flexible and reliable payment mechanism. This flexibility is particularly important in international trade, where different currencies and legal systems can complicate transactions. Whether you're a seasoned business owner or just starting out, grasping the fundamentals of bills of exchange can greatly enhance your understanding of financial transactions and credit arrangements. This knowledge can be a powerful tool in negotiating better terms and managing financial risks. This guide will delve into the definition, features, and parties involved in a bill of exchange. We will explore how these elements come together to create a robust financial instrument. We will also explore the various types of bills of exchange and their specific applications. Each type serves a unique purpose, and understanding these can help you choose the right one for your needs. By the end of this guide, you will have a solid foundation for understanding this important financial instrument and its relevance in the modern business landscape. This knowledge will empower you to make informed decisions and navigate the complexities of financial transactions with confidence. Understanding financial instruments is key to navigating the complexities of business and commerce. It allows you to leverage these tools to your advantage, ensuring the success and growth of your business. Let's embark on this journey to demystify the bill of exchange and equip you with the knowledge to confidently engage in financial transactions. With this understanding, you'll be better prepared to handle the financial challenges and opportunities that come your way. A bill of exchange is essentially a written, unconditional order issued by one party, instructing another party to pay a specified sum of money to a third party on demand or at a predetermined future date. It is a negotiable instrument, meaning it can be transferred from one party to another before its maturity date. Think of it as a formalized IOU that holds legal weight and can be used for various financial purposes. To simplify further, imagine a scenario where Company A purchases goods from Company B. Instead of immediate cash payment, Company A might issue a bill of exchange to Company B. This document, signed by Company A, orders their bank to pay Company B the agreed-upon amount for the goods either on a specific date or upon presentation. The beauty of the bill of exchange lies in its simplicity and flexibility. It acts as a legally enforceable promise of payment, ensuring that the seller receives their due amount while providing the buyer with a credit period to manage their cash flow effectively. This instrument bridges the gap between immediate payment and credit purchases, facilitating smoother transactions in the business world. In essence, a bill of exchange is a powerful tool that streamlines financial transactions by providing a legally binding framework for deferred payment while ensuring the rights and obligations of all parties involved are clearly defined. Several key features define a bill of exchange and distinguish it from other financial instruments, making it a unique and essential tool in the world of finance. Recognizing these characteristics is crucial for understanding how this instrument operates and its role in financial transactions. Written and signed. A bill of exchange must be in writing and signed by the drawer, the party issuing the bill. This written format provides legal validity and ensures all parties agree to the terms, creating a binding agreement. Unconditional order. The order to pay a specific amount must be unconditional. No contingencies or conditions attached to the payment can be present, ensuring the payment obligation is clear and absolute. Fixed sum of money. The bill must clearly state the exact amount of money to be paid. This clarity eliminates any ambiguity regarding the payment obligation, making it straightforward for all parties involved. Specific parties. A bill of exchange involves three main parties: the drawer who issues the bill, the drawee who is ordered to pay, and the payee who receives the payment. Negotiability. Bills of exchange are negotiable instruments, meaning they can be transferred to another party before the due date, adding flexibility and utility to the instrument. This transferability allows the payee to use the bill as a form of payment or to obtain credit, enhancing its practicality in various financial scenarios. Payment on demand or fixed date. The bill specifies whether the payment is due on demand, site bill, or at a predetermined future date, time bill. These features collectively ensure the legal enforceability and smooth operation of a bill of exchange, providing a reliable method for managing financial obligations. They establish a clear framework for payment obligations, timelines, and the transferability of the instrument, making it a reliable and versatile tool for financial transactions, widely used in both domestic and international trade. A bill of exchange involves three primary parties, each playing a distinct role in the transaction: the drawer. This is the party initiating the bill of exchange, essentially the creditor in the transaction. The drawer is the one who creates the bill and specifies the amount to be paid and the payment terms. The drawer is typically the seller of goods or services who is owed payment. They are the ones who have provided the goods or services and are now awaiting payment. They issue the bill, specifying the amount and payment terms. This document serves as a formal request for payment and outlines the conditions under which the payment should be made. The drawee. This party is directed by the drawer to pay the specified sum of money. The drawee is the one who is expected to fulfill the payment obligation. The drawee is usually the debtor in the transaction, often the buyer of goods or services. They are the ones who have received the goods or services and are now required to make the payment. They need to accept the bill to create a legally binding obligation to pay. Acceptance of the bill signifies their agreement to the terms and their commitment to pay the specified amount. The payee. This is the party who is entitled to receive the payment specified in the bill of exchange. The payee is the beneficiary of the transaction. The payee is initially designated by the drawer and could be the drawer themselves or a third party. This flexibility allows the drawer to direct the payment to whoever they choose. Understanding the roles of each party is essential to grasp the mechanics of a bill of exchange. Each party has specific responsibilities that ensure the smooth execution of the transaction. The drawer initiates the bill, the drawee is obligated to pay upon acceptance, and the payee is the ultimate recipient of the funds. This clear delineation of roles helps in maintaining transparency. For example, in a scenario where a manufacturer sells goods to a retailer, the manufacturer would be the drawer, issuing the bill of exchange to the retailer, the drawee, for the value of the goods. This ensures that the manufacturer has a formal document to claim the payment. The manufacturer could then choose to be the payee themselves, or designate a third party, such as a bank, to receive the payment. This adds flexibility to the transaction, allowing the drawer to manage their receivables efficiently. This clear delineation of roles and responsibilities ensures a transparent and legally sound framework for executing transactions using a bill of exchange. It provides a structured approach to managing payments and obligations, making it a reliable tool in commercial transactions.